Greetings traders, and welcome back to another survival guide. Chris here, as always, bringing you some more information. Today's information is going to come in the form of how we can day trade with $500 or less. The reason is many people out there do think that the only way you can be a successful trader is by having an absurdly large trading account, many hundreds of thousands of dollars at your disposal to go ahead and invest on a moment's notice, and this is just not the case. Now, while there are distinct advantages to having a larger account, we're going to talk about and pretend like I only have $500, and it's my goal to share with you the thought processes that would go through my head and that I'd want to make sure that I'm employing if I was trading an account with only $500 or less. Now, before we get going, please do me a favor and click that like and subscribe button down below so I can keep coming out with content for you all out there. But without further ado, let's dive into that material and learn the proper steps to day trading with $500 or less. For beginning traders in today's day and age, it looks very possible for them to be able to trade with a lot less money than previously thought possible. This is true, but the proper steps need to be taken to ensure the maximum expectation of success. That's exactly what we're going to cover. In today's day and age, trading does seem pretty easy at first, but it is definitely a lot harder than it looks. And anyone who's ever tried their hand at trading can probably attest to this. And in fact, the trading stats themselves regarding the degree of profitable traders amongst the pool of people out there are honestly kind of terrifying at first. Some estimates say that 90% of traders are not making money. Out of that, we have 80% that are losing, while 10% are just barely breaking even. Our goal is always to make it into the other 10%. We want to make it into the 10% that are making money and doing so consistently. A big portion of how we're going to do this is by focusing on our education. Regardless of whether we have a $500 account or not, this is the correct answer that I firmly believe in. Just think about it. Lawyers and doctors spend years learning, following decades of practice to get to where they're at. Considering how complex the markets are nowadays, trading is quickly becoming a science in and of itself, and honestly has been since the very beginning. The numbers are clear. Over 80% of day traders will quit within the first 5 years. If you want to be in the other 20%, you should remember with this simple truth in mind. Learning to trade is how you learn to trade. It sounds redundant, but if you learn to trade, then you'll actually learn how you can trade. One day you'll understand what that means if you don't today. The concept here is that we want to make sure that we understand how we can continuously grow and how we can practically trade in relation to what our brains actually understand. There's an abundance of available information for us on the internet nowadays that makes the learning process very, very enjoyable when done correctly, but it can also make it very confusing if you don't know where to begin. I strongly recommend starting at the basics and focusing on technical analysis above all else. Once we know the basics of how the markets work, it's then time to choose the right assets to trade. Naturally, many new investors first turn to stocks thinking that's the easier and safer path. Surprisingly, equities aren't always the most suitable instrument to start with. Some traders prefer futures, and there's a good reason for it. Futures derive their value from an underlying asset like stocks, bonds, indices, commodities, currencies, and so much more. They have a few inherent advantages over stocks. An example would be that they are an efficient way to manage and hedge risk. They also diversify a portfolio, and they also allow us to trade on leverage and many other things. Furthermore, traders are often preferring futures due to the fact that they have lower costs as well as longer trading hours. Unlike stocks, with futures, you can trade almost 24/7 with very few interruptions. In a nutshell, futures provide beginner traders with a good bit of flexibility. One of the key benefits of futures trading is that it gives the traders with less capital access to greater purchasing power. That's because futures are inherently leveraged financial contracts. Of course, that does mean that they're also riskier, but that's what makes them so suitable for the speculation side of things. With that said, we do need proper risk management strategies when we are trading on margin, and this is a must. We want to avoid the pitfalls that come along with trading with margin, where we multiply a loss instead of multiplying the gain. When trading on a $500 account or less, it's all the more important that we first practice on a simulator because we have a lot less padding to work with. For most traders, the more time that they spend on a demo account, the higher their chances to succeed will be when they go live. Some traders can't wait to get going with real money and often end up disappointed that things haven't worked out because they went live too early. We want to keep in mind that in most cases, our emotions are our number one enemy. Trading isn't a sprint, it's a marathon, and we want to make sure that we're avoiding all that short-term volatility followed by emotional wreckage. Of course, we can't trade on a demo account forever because that won't get us anywhere. So the concept to go live should be included at the point where the demo account is being consistently profitable. We don't need to be to the degree of profitable that we want at the end of our trading career, but we want to be able to prove to ourselves that we're not just going to simply lose money or be likely to lose all our money when we finally do go live. The benefit of trading on a simulator account or a demo account is just really understated in a lot of ways. A lot of traders try to argue that it doesn't allow you to gain the experience of knowing what it's like to have those emotional factors tied to knowing that you're watching real money go in and out. And while there is some truth to that, I strongly believe that it does not outweigh the benefit that demo accounts themselves do offer, with the ability to test out your strategy with zero actual risk. Because we are so close to the proverbial floor when we're trading with a small account size, it's very important to be aware of what can actually go wrong. We always want to make sure that we're aware of what can go wrong, how many trades can we lose at our expected volume of trading that we take on a regular basis, and the amount that we're usually investing per trade. These are all factors that we want to consider and imagine them in the worst possible way, and get an idea of how long and how many trades it would take for us to blow up that $500 or less account. These are things that are not comfortable to think about at first because you're imagining the worst. But by imagining the worst, you make it less scary, and your emotional response when the worst actually happens will be more maintained, more under control, and your path to overall success in the long term is that much closer as a result. Choosing the right broker is an important part of trading with a $500 or less account because not every broker is going to be as eager to accept someone, if at all, with a small account size. The good news is that many brokers in recent years have removed the minimum account balances that are required, and $500 in today's day and age is generally enough to open an account. But we want to keep in mind that any account that will let you hold positions overnight will be subject to much higher margin requirements. For some assets, these margins can easily go over $5,000, meaning we won't be able to take a single position and hold it overnight unless we have that much in our account. Futures trading is also relatively expensive because of the high trading costs themselves. It's not unusual for brokers to charge $250 per contract for most common futures contracts. Sometimes even as high as $10 per contract can be seen for alternative assets like something maybe like Bitcoin, for example. Fortunately, the competition among brokers has really picked up in the last couple of years, keeping your options in a very good place for today's day and age. Because of the desire for brokers to be competitive with each other, they've reduced account requirements in terms of minimums, as well as even lowered fees. All of this benefits you, the trader. When starting with a capital amount of, say, $500, the best thing to do is to shop around for a while until you find a broker that really suits all of your needs. You want to make sure that you're not getting screwed over on the amount of fees that they're charging. That's one of the most important things to pay attention to when you are picking a broker, are the amount of money and the amount of fees that you're going to be paying just to trade on their platform. Matching the strategy that you're using to the size of your trading account, especially if you're using a $500 or less trading account, is extremely important. An easy example of why this is important is if we think back to one of our recent discussions when we talked about the martingale strategy. If you haven't seen that video, definitely go back and check it out, but the martingale strategy in short is a trading or betting strategy where you're looking to double your investment each time you lose until you finally get a win. The concept is when you do finally get a win, you're going to compensate for all the losses leading up to that win. This is a strategy I personally am not a fan of, but you can see why that trading with a small account would not be ideal for using a martingale strategy. You very quickly would max out a $500 account even if you started with an amount of only say $10 maximum risk per trade. And going below that is arguably not even worth the time at that point because you're really just going to cost yourself more fees for opening and closing your positions than you're making per trade if you're trading on a matter of just trying to pull a dollar here and there. So it is very important to make sure that we're matching the strategy that we're using. Now you can use the internet to find a large number of strategies that exist that do favor smaller accounts, but it is important to make sure once again that we match the strategy that we're using to our account size. We don't want to use a large money strategy on a small money account because it's just not going to work. Our account size will be the bottleneck, and ultimately it is just disaster waiting to happen. Having reasonable expectations is another important part of trading with a smaller account. This is probably one of the most important things that we can talk about because more commonly than not, when traders start off with a small account, they're gung-ho and they think that they're going to just turn that account into $1 million account within a week time frame, and that's just not reasonable. And the only way it would be possible is by going into extremely dangerous trading habits, which generally do not lead to long-term success. More often than not, it leads to a short-term gain followed by an account explosion and then a redeposit followed by a short-term gain followed by a short-term explosion followed by an account deposit, and you get the idea. It's a never-ending circle that many traders fall, and these are those traders that fall in that bottom 80%. We don't want to be those traders. We want to be reasonable and be patient with whatever it is we are doing. We need to treat our account size very similar to how we treat gravity. Whether we like gravity or not, it just exists. If we have a small account, we are going to have smaller returns expected of us than if we have a larger account. That is just the case. We do not have the availability to trade larger contracts, which equate to larger monetary gains per point as we go up and down, etc., etc. You get the idea, but it's very important to make sure that we have reasonable expectations and not let our ego get in the way. So in summary, trading with a $500 account or less is possible. We just need to include and understand the different things that we talked about, and above all else, by doing that, have reasonable expectations. If you understand the various parameters that will come along with the territory of trading with a smaller account, knowing that you're not going to make as much money per trade, most likely, as if you were trading with a larger account. If you understand that, accept that, and you're okay and you're disciplined enough to stay within those confinements as you build the account to a larger account, then you will have the ability to succeed. But if you don't have the discipline, then you most likely will fall in that bottom 80% where you're blowing up the account because you're getting too overzealous for your account size, too big for your britches. And ultimately, that is not the path to being an old trader. Remember, we want to be old traders, not bold traders. I will see you all soon. Best of luck in the markets, everybody. Over and out.